Right. So guys, as previously communicated, do not underestimate auditing. I've seen over the years it can actually ruin your lives if you're not careful. So take auditing serious. I think on all the modules that you're doing, to me, according to my experience, I think audit is the most challenging one in the sense that audit is either you get the terminology or not. So if you don't get the way they answer the questions, then you're out. So there's no compromise. Like for MAC, you can discuss MAC questions in your own way based on what you're thinking at that moment, and then you get your marks. But audit, you have to make sure that you know how to answer the auditing questions. So you have a designated or designed approach in answering each and every question. So every topic have ways in which they expect you to answer those topics. So make sure that you follow the approach. So you know that, okay, when I'm dealing with the reporting, this is the approach that I use to answer the questions. When I'm dealing with substantive procedures, I answer my questions like this. Test of controls, I answer them like this. If you do that, you won't fail auditing. But if you don't realize that, you just walk in then say, no, I'm going to write auditing, you will not do well. When you see a question on risk, have an approach. This is how I answer risk questions. This is how I answer King 4 questions. This is how I answer Companies Act questions. That's what it is about. So please, guys, change your mindset. All right, when it comes to audit, don't just do audit in this perspective to say, I'm going to answer audit. You need to know, how do I approach each and every topic? All right. So let's look at this part of the question. For now, I'm going to skip part A. All right. It's about going concern. I haven't done much with you there. So I'm going to skip it for now. We'll come back later on. All right. And then, of course, part B. All right. It's something that you guys did at the beginning of the year. All right. We're going to look at it also. And then part C, that's what we're busy with. And then part D, we haven't done this one. It's about audit report and conclusion. All right, when you're issuing the actual report there, I haven't done that with you guys. So, of course, we're doing that next week. All right, let's see what's happening. So, we're going to do B and C for now to see what's best, how best we could have answered these parts. So, it says with reference to working paper C200, litigation claims, discuss in detail the auditor's responsibilities with regards to the counterfeit products bought by Farm Company Limited in terms of the Audit Profession Act 2005. All right, so now we can agree now that in most circumstances, they want you to answer a question based on Audit Profession Act. All right, but this is something that you did beginning of the year, somewhere around March. Do you still remember it? Probably you forgot. So be careful, all right, in terms of audit. They can just examine anything, especially on this assessment. Right. And then C says discuss the impact of the individual unresolved audit differences on the fair presentation of the financial statements and the audit report. Ignore all tax implications, intangible assets, loan receivables, employee cost. Now let's go there and see. So you're the audit manager at PK Incorporated, an audit firm based in Gauteng, Free State, and in Mpumalanga. You are currently busy with statutory audit of Farmco Limited for the year ended 30 June 2025. All right. Farmco is a pharmaceutical company that has been operating since 1999 in major cities of Gauteng, KwaZulu-Natal, Limpopo, with major manufacturing sites and head office located in Durban. Farmco is recognized for the manufacturing and distribution of both branded and generic pharmaceuticals, as well as specialized cancer treatments and clinical services for patients. Farmco is listed on the Johannesburg Stock Exchange since 2007. The following working papers were made available, all right? So we have C200 and then RP 500. So in terms of this litigation claims, during the discussion with Farmco's legal experts, Ms. Yanda, it was discovered that on 27 June 25, Farmco was sued by its major client, CareMed, and is considering discontinuing its supply of products to Farmco. Farmco has been using counterfeit products that resemble those of Chemed in terms of branding and packaging. Ms. Yanda mentioned that Farmco preferred the counterfeit product to those of Chemed as they were cheaper. Ms. Yanda indicated that the most likely outcome is that Farmco will have to pay settlement of 2.5 million to Chemed as the sale and purchase of counterfeit products is in contravention of Counterfeit Goods Act. Furthermore, the counterfeit products have not been approved by the SAPRA. The board of directors approved the use of counterfeit products for resale following a presentation by Mr. John, the Chief Financial Officer, regarding the budget for the 2025 financial year at the board meeting on 20 June 2024. Mr. John indicated that it would be better for Farmco to use counterfeit products as it would result in more profit for Farmco. Farmco has used the counterfeit products since October 2024. Loan to fund a patent. In February 2025, the United States of America, Mr. President Donald, announced that the USA is no longer funding South Africa for medical research and medical drugs. This announcement affected Farmco's distribution of HIV and AIDS antiretroviral, as Farmco was funded by the USA government. The HIV and AIDS patients of Farmco were severely affected. The USA government intervened by giving grants to medical companies to convene with the manufacturer of HIV and AIDS ARVs. The board of directors of Farmco immediately convened a special board meeting on 20th February 2025 and approved the development of ARV medical research for their patients. And then the board of directors identified senior employees of Farmco and assigned them to the medical research task team responsible for researching and manufacturing of the ARVs. Farmco obtained 10 million loan on 3 March 2025 from its bank to fund the research of the ARVs, which will then be patented by Farmco after obtaining the loan. Farmco debt to asset ratio was 2:1.9, and the current liabilities exceeded the current assets. Medical research team. On 1st of June 2025, the medical research team that was appointed for the research and manufacture of ARVs resigned, stating that they are overworked, cease the work on the ARVs, and also continue with their other responsibilities to Farmco. No one was employed to continue with the research and manufacture of ARVs. Therefore, no handover of the research was done. Right, so basically that's what we have. All right, and then so we have a working paper there. So in terms of this working paper, the objective is to identify unresolved misstatement for further assessment. Final materiality figure was set at 1.2 million. The following unresolved audit difference were noted. Audit difference 1, intangible asset. As a result of the withdrawal of funds from the USA President and Farmco's Board of Directors' decision to embark on medical research for HIV and AIDS, ARVs, the research team started the research on 20 March 2025. The research cost amounted to 1.8 million and were capitalized to intangible asset. This cost did not meet the recognition in terms of IAS 38 intangible asset. Mr. John stated that the reason for capitalizing the research cost is because they incurred the research cost and need to show the intangible asset in their financial statements, and no correction is needed. The intangible asset is considered to have indefinite useful life. All the intangible assets were tested for the audit. Unresolved audit difference 2. During the audit of other receivables, it was noted that a loan of 300,000 was paid to Miss Susan, one of the directors of Farmco. The loan to Miss Susan was discussed at the board of directors meeting. The loan was granted after obtaining appropriate statutory authority in terms of Section 45 of the Companies Act. There were no other disclosure on this loan to Miss Susan. Mr. John did not see the need to disclose the loan separately on the annual financial statement. This was the only loan receivable during the current year. Unresolved audit difference 3, employee cost. To test employee cost, a sample of 55 employees was selected. The information, contracts, salary, grades, salary increases relating to the sample of employees' cost was not provided to the audit team, thus it could not be tested. Management informed your team that the information relating to employee cost is missing and they are trying to retrieve it. Your team waited for the information until they were done with the schedule of the statement working paper. You inquired with Mr. John, who informed you that they could not retrieve the information as it was destroyed by the floods. According to the annual financial statement of FAMCO for the 2025 financial year, the employee cost line item amounted to 5 million. Right, so basically, this is the information that we have, all right, and that's to our client. So let's quickly account for it now and see how best we could have answered this question. All right. So in terms of the first part, all right, we could have answered the part on going concern, but let's do going concern as a separate topic. All right, let's look at part B. It says, discuss in detail the auditor's responsibility with regards to counterfeit products brought by FAMCO in terms of the Audit Profession Act. All right. So in terms of this, all right, FAMCO, P2I, Ltd. All right, we want to present this company. So now let's note, right, in regards to this now, let's note now what is happening. So Audit Profession Act. Right, I want you guys to note now, the Audit Profession Act, guys, it deals with what we call reportable irregularities. All right, I'm sure you can recall from the first assessment. All right, so the Audit Profession Act, all right, deals with reportable irregularity. All right, so that is what the Act is about. It deals with reportable irregularity. All right, so now what is expected of us now, guys, is when it comes to reportable irregularity, all right, we need to understand what is a reportable irregularity, all right, in terms of Audit Profession Act, all right, we need to know that, and also we need to know what are the responsibilities of the auditor in regards to that. All right. So by definition, guys, a reportable irregularity, all right, is defined as an unlawful, all right, it is an unlawful act, all right, or omission. So it's an unlawful act or omission by someone, all right, in the management of an entity, all right, that causes or is likely to cause, all right, material financial loss, all right, or is theft, all right, material financial loss, or is theft, or fraudulent, all right, or represents material breach of fiduciary duty, all right. So now, so in regards to this, this is what we call a reportable irregularity in terms of the Audit Profession Act. So they call it APA. Now, when you're answering questions, right, like for instance, this question now, it has 11 marks. All right. Auditors have a responsibility. All right. Auditors have a responsibility to report a reportable irregularity to IBA. So IBA is the regulatory board for auditors, all right? Not SICA, all right? Don't get confused. So now what happens now, guys, is I remember when you did on the introductory class, all right, you noted that in order for you to be a registered auditor, all right, you need to be, you have SICA, all right, you're done with SICA, or you have ACCA, all right, so they recently merged. So IBA and ACCA recently merged, I think it was last year. So they merged. So you need to have either SICA or ACCA, all right, and then once you have those training contracts and the sign off and the qualification, you then do now the IBA. All right, so you do now the learnership under the IBA, which lasts roughly around 2 years or so. So you'll be under the IBA training. So now you then become a registered auditor. So a registered auditor now, in regards to this, they need to first identify, is there a reportable irregularity? Now, what is a reportable irregularity? We are saying now it is unlawful act or omission. So in terms of this, all right, when you are discussing a question, they say discuss the responsibility of the auditor. You can't just say, no, the auditor is a responsibility to report to IBA and then expect to gain 11 marks. So you first have to identify if there's a reportable irregularity. Then you break it down. Is there any unlawful act? So let's answer this question. Unlawful act or omission. So let's see what is going on in our scenario. So they said refer to a working paper C200. Let's see if there's anything unlawful happening in C200. So C200, summary of information. Here we are. So during discussion with Farmco's legal experts, Ms. Yanda, it was discovered that 27 March 2025, Farmco was sued by its major client, all right, and is considering discontinuing supply of products to Farmco. Farmco has been using counterfeit products that resemble those of Chemed. In terms of branding and packaging, Ms. Yanda mentioned that Farmco preferred the counterfeit products to those of Chemed. Now, let's look at Ms. Yanda. All right, we're going to come back to you, Ms. Yanda. All right. As the sale and the purchase of counterfeit product, all right, in regards to this, so you were told now the sale and purchase of counterfeit product is in contravention of the Counterfeit Goods Act. Furthermore, the counterfeit products have not been approved by the South African Health Products Regulation Authority. So, which means now, in regards to this, all right, in terms of this, do you see there is an unlawful act in terms of this question? All right, what is the unlawful act, guys? What is this company doing? The sale of counterfeit products because it's not approved by the South African Health. So you then have to start. When you're answering your question, you break it down. Unlawful act or omission. So you then say the sale of, so the sale of counterfeit product. All right, the sale of counterfeit products, all right, is unlawful. All right, but it is unlawful against, so it's unlawful against which laws? So it is unlawful as it is against now, you then tell them in regards to this, it is against Contravention of Counterfeit Goods Act. All right, so it is against Counterfeit Goods Act. All right, then now you have told us now that the sale of the counterfeit product is actually unlawful. You can move on to mention about it's not approved by the South African Health and all that, but you have proven that no, what the sale of this product is unlawful. Now let's look at it. By management of the entity. Now you want to discuss now by management. All right, you break it down. Who is doing this sale? All right, in regards to this. So let's quickly look at it now to see now who's authorizing this sale of these counterfeit products. All right, who started with this? All right. Now, the board of directors approved the use of counterfeit products for resale following a presentation by Mr. Koza. Now, Mr. John Koza, who is this guy? The chief financial officer regarding the budget for the 2025 year at the board meeting. All right. So Mr. John indicated that it would be better for Farmco to use counterfeit products as it would result in more profit. Now, here's the problem. Now, who's in management who's approving the use of counterfeit product? So you start off by saying the board of directors. All right. Together with Mr. Koza. All right. Approved. Mr. Koza is, what is the role of Mr. Koza? So Mr. Koza is the CFO, Chief Financial Officer. Approved. The use of counterfeit product. All right. Now, you have proven that no, based on my reportable regularity, someone in management, who in this case is the board of directors, as well as the chief financial officer, approved the use of this. Now, the next task now, let's prove now that to say that causes or is likely to cause material financial loss. So causes so it causes, all right, material financial loss or is theft or fraudulent. That's what we want to prove now. Is this theft or fraudulent? Right. So let's see. Is there anyone who lost? All right. So now we can see in regards to this, all right, Ms. Yanda indicated that most likely outcome is that Farmco we have to pay settlement of 2.5 to CareMed, as the sale and purchase of counterfeit product is in contravention of this act. All right. So that is what we have in regards to this. So how is this theft? All right. In regards to this, how is this theft or resulting financial loss? Now, what do you guys need to note in regards to this? Now, this amount to material financial loss to our company. Remember, if they pay the 2.5, the fine of 2.5 million will result in material financial loss to Farmco. So a fine of 2.5 million will result in material financial loss to Farmco. All right. So the fine of 2.5 will result in material financial loss to Farmco. But let's look at it. All right. In regards to this, what about fraudulent? What is fraudulent, guys? Fraudulent arises through omission. All right. What are these guys doing? All right. They're packaging. All right. In regards to this, the directors of Farmco, they're packaging the counterfeit product. All right. They package and brand it to resemble CareMed products. You guys can agree with me now that that's fraud. All right. So the packaging now, the packaging of counterfeit product. Products. All right. Packaging of counterfeit products. All right. In resemblance, in regards to this, in resemblance to those of CAMED. Those of CAMED is fraudulent. You see that? Now, so in regards to this, you have applied the definition of a repeatable irregularity. Now let's look at what about represent material breach of fiduciary duty? What is the duty of the directors? Is to act in the best interest of the company. Now we need to state that the CFO, who is Mr. Koza, is in a breach of director's duty, which is to act in best interest of the company. All right? So in regards to this, he is not acting in the best interest of the company. All right? What then do you make a conclusion? All right? In regards to this, you then state this is a reportable irregularity. So you now have to state to the examiner now that this is a reportable irregularity. So what are the steps of the auditor now? Right? You have identified that no, a reportable irregularity actually exists. All right? In terms of this, there is a reportable irregularity which exists there. All right? In terms of this. So what are you supposed to do? All right? In regards to this. So now, Audit Profession Act, it says now, without delay, the auditor should send a written report to the board, which is IBA. So in regards to this, first thing that they do, without delay, the auditors should send a written report to, you can say, the regulatory body or to IBA. All right, without delay, the auditor should send a written report to IBA. All right, giving the particulars of the reportable irregularity. All right, so you are telling IBA that no, Mr. IBA, there's a reportable irregularity which exists here. All right, and then what else are we supposed to do? 2, within 3 days of sending the report. All right, within 3 days of sending the report to IBA, the auditor must send another report. Right? The auditor must send a report, all right, to the governing board. The auditor must notify the governing board. All right, you must notify the governing board, all right, in writing about the reportable irregularity. So you need to notify the board to say, no, look, Mr. Board, all right, this is the company's governing board. In writing, you write to them, there's a reportable irregularity taking place within your company. All right. Then, within 30 days, all right, so within 30 days, the registered auditor must send another report to regulatory board, which is IBA. All right? Detailing. So now on this report, you should detail if the reportable irregularity still exists. All right? Or if the reportable irregularity has been resolved. So these are the duties of an auditor with regards to a reportable irregularity. Any questions for me, guys? Is there anything that you do not understand in regards to what we have done so far? Are we good? Are you guys there?
I'm good.
Okay. All right. Cool. So please run through that part. So what you need to do is, on a reportable irregularity, you need to understand someone in management is doing something wrong. All right? That's what you need to pay attention to. So someone in management is doing something wrong. So that's what makes it a reportable irregularity. All right? Fantastic. Now let's look at the next part of our question. So the next part, it says, with reference to working paper RP 500, discuss the impact of the individual unresolved audit differences on the fair presentation of the financial statements and the audit report. All right, so what are the impact of these on financial statement and audit report? So ignore all tax implication, the intangible asset. Let's go to RP 500. So this is C, all right, working paper, RP 500. So in this case, these are misstatements. All right, so unfortunately now, remember now on that, when we did this topic, we attached it as audit misstatements, but they're not going to tell you that they're misstatements. They'll just give you the information. So it's crucially important that you link your audit with your accounting. So you've been told final materiality is 1.2 million. So any misstatement above this is quantitatively material. Right, let's see. As a result of the withdrawal of funds from the USA President and Farmco's Board of Directors' decision to embark on medical research for HIV and AIDS, ARVs, the research team started the research on 20 March 2025. The research cost amounted to 1.8 million and were capitalized to intangible asset. Now, in terms of this, on this topic, you need a little bit of accounting knowledge, unfortunately, all right? But I'm sure you guys are aware that when you're auditing, you're actually auditing accounting. So you have to know that in regards to this, how do you account for research cost? All right, so guys, a research cost, we capitalize them. So we expense them. Then development cost are the ones that we add to intangible asset. So what they did here is incorrect. Let's look into it. What is difference one? So research cost were added to intangible asset. All right, this is incorrect. Research cost should be expensed. All right, that's what correct. So research cost should be expensed. Of course, there was no mark for this. I'm just guiding you guys on how your approach could be. But now they capitalized a research cost of 1.8. All right, so what is the implication of that? So it means now remember, we state our approach in regards to this. We say, what is the impact of this? So there is overstatement. Intangible assets were overstated by 1.8 million. All right, so we overstated, we provided too much intangible assets by 1.8 million. Now, what is the impact of this? The capitalization is adding the capitalization of research cost to intangible asset is non-compliance with IFRS. Remember, IFRS is the accounting standard. But let's say, so sometimes in the exam, guys, it's not all people who pass an exam knew their work. Some people are intelligent in terms of analyzing information. Guys, not everything that you should know when you walk in the exam. Let's see how you could have pulled through this one. The examiner always give you hints, right? You see, this cost did not meet the recognition criteria in terms of IAS 38 intangible assets. What are they trying to tell you there? They're trying to say the research costs should not be added to the intangible asset. But unfortunately now, because sometimes, as students, we develop this habit to say, nah, me, I know what I'm doing. But the examiner is giving you these hints, all right? So Mr. John stated that the reason for capitalizing the research cost is because they incurred the research and need to show the intangible assets in their financial statement. Now, so you can't tell me that Mr. John is going to convince you. You know that IFRS is saying, no, research costs should not be capitalized. They gave you the hint. So now you have to tell the examiner now that the capitalization of research cost to intangible asset is non-compliant with IFRS. Now, let's evaluate. Remember, we said now the next task now is to determine if the misstatement is quantitatively material or not. So the research cost of 1.8 million is more than final materiality of 1.2 million. Therefore, the misstatement is quantitatively material. Remember, we said something is quantitatively material if the actual amount is more than your final materiality. So it becomes quantitatively material. Right. Now, the next thing now that we need to state in regards to this is this misstatement qualitatively material or not? Remember now, in terms of qualitatively material, we spoke about factors which causes misstatement to be qualitatively material. We spoke about factual misstatement. Let me see if I still have it, right? So we said we have factual misstatement, right, which arises as a result of non-compliance with the laws and IFRS. Then we have judgmental misstatement, which arise as a result of the differences in interpretation between the auditor and the accountant. Judgmental misstatement arises as a prediction of things like useful life, depreciation method, and all that. And then we have projected misstatement. This one arises as a result of sample sizes, the population. So in our question, we are saying now the misstatement is qualitatively material as it is non-compliance. So you have to tell them it is qualitatively material, then you give a reason. It's non-compliance with IFRS and Companies Act. Remember, we spoke about it where we said Companies Act says companies should comply with all laws and regulations. So IFRS is a law, right, that governs accountants. So if you fail to comply with IFRS, it automatically means you fail to comply with Companies Act. All right, that's what we have. And then you state the type of misstatement. This is a factual misstatement. All right. Remember, you said no, this is a factual misstatement as it is non-compliance with IFRS. in the Companies Act. So you're saying, no, this is a factual misstatement. So if you do that, if you use that approach, then you're very closer to getting your marks. Anyone who's lost so far? Right. Let's look at the next one. Right. Misstatement 2. So we have, during the audit of other receivables, it was noted that a loan of 300,000 was paid to Miss Susan, one of the directors of Farmcom. The loan to Miss Susan was discussed at the board of directors meeting. Now, unfortunately now, guys, they're bringing you back into different aspects. There's a lot of things to be discussed here. You guys did Companies Act, right? So as you'll be preparing for test 4, I want you guys to go back. Just read through. Remember, I gave you a summary of Companies Act. I'm sure you guys still remember. There's a PDF document that I gave you, which is a summary of the sections of the Companies Act. I want you guys to run through that as quick as possible. Now, loan to director. Who's Miss Susan? Miss Susan is a director. You see, she's a director. So what does the Companies Act say with regards to issue of loans to director? It says a director can receive a loan from a company, but the terms of the loan must be fair, all right, and reasonable. The company must be solvent, all right, and liquid soon after giving the loan. That's why now, you remember now, you guys are doing ratios on your MAC. So which means now, if you did ratios on MAC, they might also come in handy here. There's a loan. But now you need to test, is the company solvent and liquid? All right? And then the next thing, after granting the loan, what's happening? The loan was granted after obtaining appropriate authority in terms of Section 45 of the Companies Act. So in other words, they're saying, no, the company did comply with regards to Companies Act, no violation. The company was solvent, all right? The company is liquid, the terms were fair. There were no other disclosures on this loan to Miss Susan Wayne. Here's a problem. Why? Miss Susan is a related party to this company. Have we done related party on FAC? Yes, no? Related parties. Have you guys done those ones? Guys, anyone? Do you guys know what are related parties? Have you?
Yes, I think we did, Ian.
We did related parties. Okay. Right, let's just do a quick recap. What are related parties? So, guys, a company and its subsidiary. So, subsidiary is a company that has the holding company has at least 51% shareholding. They become related parties. So, if they transact together, they are required to record. So they provide the type of transaction that took place between each other. So there will be a note, they disclose the note. That's what we have in related parties. Then associate is also a related party to the holding company. So an associate is a company where the holding company has between 20% to 49% shareholding. We call it significant influence. So if it's an associate, you're required to provide a disclosure of the events that took place between the holding company and the associate. Then, individuals. Companies and key management personnel are related parties to the company. Like, for example, directors, managers. So those guys are also related party to the company. So any transaction that takes place between the company and those parties, we should disclose them in the financial statements. So we're now being told now that there were no other disclosures on this loan to Miss Susan. All right? Mr. John did not see the need to disclose the loan separately on the financial statement. Now, this is non-compliance with IFRS. All right? So we now need to discuss that. So for starters, right, in regards to this, let's quickly look at it. All right? In terms of this, what is going on in terms of the loan? So we can see, is the loan amount quantitatively material? You can see it's 300,000. It's below 1.8 million. All right? So let's account for that. So loan to Miss Susan. All right? Now, the loan amount of 300,000 is less than final materiality amount of 1.2 million. Therefore, the misstatement is not quantitatively material. So you're saying no, it's below our final materiality, so it's not quantitatively material. Right? Now, the misstatement, right, in regards to this, the misstatement is non-compliance or non-disclosure of related party transactions. All right? So the misstatement is non-disclosure of related party transactions. Then you start non-disclosure now of loan to Miss Susan, a director, is qualitatively material as it is non-compliance with IFRS and Companies Act. So this is IS 24 in terms of IFRS, all right? Non-compliance with that. So what type of misstatement is there? This is a factual misstatement as it is non-compliance with IFRS. It's a factual misstatement. It's non-compliance with IFRS and Companies Act. All right, so you state to the examiner. Right. And then, so you're saying, no, this is a factual misstatement. All right. Then you move on. You move to the last point. So the last point, it says, unresolved audit difference 3, employee cost. To test employee cost, a sample of 55 employees was selected. The information, contract salary, grades, salary increases relating to the sample of employee cost was not provided to the audit team. Thus, it could not be tested. Management informed your team that the information relating to employee cost is missing and they're trying to retrieve it. Your team waited for the information until they were done with the schedule of misstatement working paper. You inquired from Mr. John Koza, who informed you that they could not retrieve the information as it was destroyed by the floods. According to the annual financial statements of Farmco for the 2025 financial year, the employee cost line items amounted to 5 million. So what is happening in regards to this? There is limitation of scope. All right, we're going to look at that next week. So the auditor is not in position to do all their work because they did not receive all the information they need. So we have limitation of scope. So what do we do in regards to this? So there is a misstatement. 3. All right. So you can start. So for starters, there's an easy marks. All right. So in regards to this, the misstatement of 3 million on employee cost is quantitatively material as it is of final materiality of 1.2 million. All right, so it's quantitatively material. Now, what is happening? There is a projected misstatement. So this is the only time now where you have a projected misstatement. There is a projected misstatement as the sample size of 55 employees could not be tested. You can't test it. All right. Is it qualitatively material in regards to this? All right. The misstatement is not qualitatively, but this one is debatable, though. Somebody can say it is qualitatively in the sense that it's fraud. Management is destroyed information. So in regards to this, you can say it's qualitatively material, all right, depending on how you interpret it. Somebody can say it's qualitatively material as management could have destroyed evidence, all right, as management could have destroyed evidence on employee cost, all right? So it depends with what you have in regards to that part, right? And then that's how we can go about it, all right, in regards to that part. All right, any questions for me, guys, in terms of the information we have there? Questions, guys? No questions. All right. So can you guys go through these parts that we have done? All right. Go through them nicely, have understanding. Then next week we'll look at, of course, the types of audit reports and how we can answer those aspects there. All right. Have a wonderful weekend, guys. Bye.
Bye, Ian.
Bye.
Bye.
Bye.